For a qualitative and quantitative review of the anatomy of a crypto market bottoming, please join founder of Ikigai Asset Management, Travis Kling.
How we doing? Ooh, that was loud. How we doing? Travis Kling, founder of Ikigai Asset Management. Going to talk to you a little bit about what's been going on with prices year to date for the broader crypto market. First, a quick disclosure from my legal counsel. Shout outs Perkins Coie. This is not investment advice, and I am not soliciting Ikigai Asset Management as a fund. So Ikigai, if you're not familiar with that word, it's an ancient Japanese concept that means reason for being. It's a combination of what you're good at, what you like to do, and what the world needs for the purpose of delivering superior risk-adjusted returns. So we sort of took a 1,200-year-old word and adapted it into the mantra of our fund. So I come from a traditional hedge fund background. Been out of college for 11 years, and the first 9 of those years was in one direction, which was energy investing. I worked at a hedge fund called Magnetar Capital in Chicago, doing long-short energy equities and non-control private equity and debt. I was a portfolio manager at Point72 and here in New York, Steve Cohen's hedge fund. So I'm not a tech guy. I'm not a tech investor, and I'm not really much of a tech guy. I don't own an Apple Watch. I think Alexa's big brother. I've always been like that. So first time I heard about Bitcoin was when Silk Road got shut down, just from a fascination perspective. Like, look at these crazy drug dealers that made this magic internet money to go buy drugs on the internet. That's just wild. And then Mt. Gox got hacked in early 14, and that was sort of confirmation to me that this wasn't really an investable asset class, because I didn't have any way to try and mitigate or price in the risk. I was going to wake up one morning and somebody stole all my stuff, so I stopped paying attention to it. Fast forward to the back part of 16, and the price started going back up again, and it popped back up on my radar. And I remember getting into the subreddits and the Bitcoin talk forums and being amazed that this thing didn't die after Mt. Gox. And not only was it not dead, it looked like it was more vibrant now than it's ever been before. And that really caught my attention, because it struck me as something that was anti-fragile in the same way that Nassim Taleb talks about anti-fragility. And in my opinion, which we're going to get into in a little bit here, what central banks have done with monetary policy since the financial crisis has caused a lot of distortion in asset price discovery in public markets. And it's made assets around the world very fragile and addicted to cheap money. And Bitcoin struck me as something that stood completely outside of that, and I thought that was important. I fell down the proverbial crypto rabbit hole in earnest summer of 17. Convinced myself that distributed ledger technology was going to be the most significant investment opportunity of a generation, the most significant technological innovation since the internet the first time around. So I left Point72 in December 17, moved out to Los Angeles where my partners were based. We spent basically all of 2018 building Ikigai Asset Management, and we launched in January of this year. So up to 25% of our AUM, we can do venture investing in the crypto space. And then the rest of that capital goes into a long-short multi-strat hedge fund. So liquid hedge fund strategies applied to the crypto asset space. And so this bonsai tree is like a graphical representation of our liquid fund strategy. And the only reason I mention this is because what we've done is these 4 foundations down here: qualitative research, fundamental valuation, quantitative tools, and event-driven catalysts. There's a couple thousand hours in aggregate of work that goes underneath those 4 foundations. So we've built a lot of tools to help us understand what's going on in this market. And those 4 foundations, they generate a couple dozen signals in aggregate. And we just take the preponderance of evidence that's generated by those signals, and we make investment decisions accordingly. So it's like an idea factory that creates a repeatability to your investment process. And the only reason I mention this is because, like, it was that engine that's helped us understand sort of what's been going on in this crypto market year to date, which is what this presentation's about. So this is what we're going to cover today. Where are we? Broadly, how did we get there? Whoops. There we go. Where are we? Broadly, how did we get here? Specifically, how did we get here? What are the chances that we've bottomed? It's a discussion about crypto market participants and crypto market price action. So where are we? This chart's a little outdated. I put this up here on the flight yesterday afternoon. Can we just give a quick round of applause for the crypto market coming back? Just real fast. That's a good feeling, right? So just to give you a sense of numerically what that looks like, BTC's up 63% year to date, ETH's up 26, and you're 90%, you're basically doubled off the low of mid-December. So very firmly have bounced. A lot of that happened on April 1st and subsequently, but the pieces were getting put in place prior to that. So broadly, how did we get here? So in 2008, we had the beginning of the largest monetary and fiscal policy experiment in human history. Quantitative easing while simultaneously running increasingly larger deficits on top of increasingly untenable debt loads. And that's not hyperbole, that's unequivocal fact. The US printed about $4.5 trillion over that period of time. The largest central banks globally printed something like 15 trillion. That's the largest monetary experiment in human history. And then in 2017, the Fed tried to start ending the largest monetary experiment in human history with quantitative tightening. And in 2018, risk assets around the world started not liking that very much at all. Crypto was actually the first to go, which makes sense because it's sort of the furthest out on the risk spectrum. And then one asset class after another started falling until by the end of 2018, you had more asset classes globally with negative returns in a year than you've ever had, ever. Specifically in Q4 18, you had this sort of like dumpster fire for risk assets. Everything was tanking. Steve Mnuchin calling the plunge protection team from Cabo on Christmas Eve. The market, if you pay attention to what the Fed does, Jay Powell, the chairman of the Fed, used this term in mid-December about how balance sheet was on autopilot, the balance sheet roll-off and tightening, and the market really, really didn't like that term, autopilot. And you know who else didn't like that term? Donald Trump didn't like that term. So Donald Trump started talking shit on Twitter to the chairman of the Fed, and the crazy thing about it was that it actually worked. So in January 30th, the Fed capitulated, and they went from this stance of tightening and balance sheet roll-off and pushing up interest rates further, complete turnaround to dovishness and accommodation by any means necessary, and sort of all future tightening going on pause. That's a big deal. And then on March 10th, Jay Powell went on 60 Minutes and he confirmed it. And then on March 26th, they had another FOMC meeting and they were even more dovish. And then because the United States did it, then let's see here. Because the United States did it, then all the other central banks globally could fall in line. The ECB, the BOJ, the PBOC, Reserve Bank of Australia. 2 days ago, the Reserve Bank of New Zealand cut interest rates. In case you're wondering how quantitative tightening is going. The first large global economy to do so in 2019. And the punchline is like, so the whole world's monetary policy shifted over the last couple months from trying to end the largest monetary experiment in human history to having no desire to try and end that. That's really important as a backdrop for crypto assets. Specifically for Bitcoin, crypto is definitely a risk asset, but Bitcoin is a risk asset with a specific set of investment characteristics that become increasingly more attractive the more irresponsible monetary and fiscal policy becomes. It's a hedge against that. It's an insurance policy against that. So I've talked about this a lot in public, and we're not going to stop banging this drum. Current central bank actions are deeply bullish for a non-sovereign hard cap supply, global, immutable, decentralized digital store of value to gain mass adoption. There's a good chance this crypto bear market is over, and there's a good chance that Jay Powell put the bottom in. So I wrote this like monthly update letter that goes out to our investors and potential investors. It goes out the first of every month, and that statement was in that letter, and it was like 4 hours before BTC went up 25%. Not saying I caused that, just saying it was good timing. So that was kind of broadly how we got here. Specifically, how did we get here? So this is kind of how we see things year to date, leading up to April 1st. So Tron rallied more than 80% in January on the back of this BitTorrent thing. That peaked in January 10th, the day of the airdrop, and then it dumped 35% in the following 4 days. ETH pumped twice, right? First on the Constantinople hard fork, and then they had to push it off, and so it kind of dipped, and then it pumped again like that. So you had that going on in kind of the January, February timeframe. And then you had BNB that was starting this, like right when Tron started collapsing, then BNB started pumping. And then CZ like goes on this relentless value sort of creating campaign, and he's doing all these fiat on-ramps in Argentina and Australia, and then he's got Launchpad, and BNB as a token's performed really well year to date. And then from the signals that we saw, especially with hindsight, February 8th, it's fair to say that everything changed on February 8th with this crypto market, and that emanated from Litecoin pumping 30% in a day. It was the largest stop run on Litecoin in BitMEX history. It came on this like really loose kind of news of Charlie Lee talking about implementing Mimblewimble, which is like pretty soft in terms of a catalyst, and then seemingly like every time Litecoin would start kind of dipping, and it looked like it was starting to fade away, then you'd see this bump up again on like no news, and that started February 8th and continued through the end of February and into March, and then seemingly with permission from and in conjunction with Litecoin leading the way, you had these small cap cryptos that started pumping, and some of them were pumping on like event-driven catalysts, like Engine or Theta. Some of them were kind of pumping on not much of anything, but they were pumping, and then they were actually kind of maintaining a decent amount of that pump instead of these like very quick, like like the true pump and dumps, like in a couple days. And so that was very different in terms of showing a risk tolerance that market participants were taking at the time. And then on April 1st, we had fireworks, and specifically, what do fireworks look like? Fireworks look like $480 million of BitMEX liquidations in 2 hours. And just like that, the bottom was in for crypto. Legitimacy of the Q1 rally. So I kind of like to compare BNB to Litecoin in this situation. So in our opinion, far and away, the Q1 pump that had the most sort of fundamental legitimacy to it was Binance. He's doing a great job adding value, driving value, but he's doing it in his own unique way. Any Launchpad IEO participants in the room right now? Maybe not. Okay, but people have probably been paying attention to it. And what CZ's doing is he's created this little mini 2017 ICO mania, but he's doing it in his way because he's got all his market makers that are supporting the books of these IEOs. So he's entered this social contract with IEO investors, and he's basically said, like, if you do, and you can only do $1,500, so it's not like even an institutional product, but if you do a little bit, I'm gonna make sure you make like 2, 3, 4 times your money. And you get to make it in this kind of fun, gamey, gambly way that like investors in that part of the world really enjoy. And then on the other hand, you have Litecoin. And Litecoin is a heavily manipulated crypto, and it has very little fundamental value. So the number of developers committing to the Litecoin GitHub has gone from 40 in 17 to about 3 currently. And importantly, only 78 addresses hold at least $10 million worth of Litecoin. 1,011 addresses hold more than $10 million worth of BTC. Only 324 addresses hold $1 million worth of Litecoin. So because of that reason, like just think about like a 78-person Telegram chat, and it's every dude in the world that owns $10 million worth of Litecoin. Those guys can get together and they can make Litecoin do some things. It's also shorting Litecoin at large scale as opposed to ETH and BTC, which have true two-way price discovery. You can't short Litecoin in size very well. So also, another thing that we pay a lot of attention to is all the wash trading that happens in crypto, which folks in this room are probably pretty familiar with. And when you look at the historical volume profiles, it supports this thesis of increased wash trading that kicked off on February 8th. And that was likely in response to these offsides long-short positioning on BitMEX and Litecoin. And if you just kind of go back and look at the chart, it's pretty apparent that like some switches were flipped on in February 8th. So how does all that happen? So I'm going to introduce this concept called the risky whale. We believe a relatively small number of highly sophisticated, well-capitalized, highly risk-tolerant market participants have been walking this crypto market higher over the sort of 7 weeks from February through March, and then that was punctuated with these April 1st fireworks. And if anybody's like an active trader in here, maybe you've heard of this guy Wyckoff. He wrote books about the stock market in the early 1900s. Wyckoff has this guy called the composite operator that he talks about, and the risky whale is crypto's own version of the composite operator. So why have these risky whales been willing to initiate these market manipulations over the last 7 weeks, going through February and March, leading up to the April 1st fireworks? Because after all, if these trades go against them, they stand to lose millions of dollars. Well, we believe it's because the risky whales are aware of a bid in BTC that keeps the entire market afloat. We know anecdotally of crypto funds that were buying BTC for a long-term hold in the December, January, February timeframe. Fidelity has assumedly been buying some amount of BTC and is assumedly going to be continuing buying more. And then anecdotally, we've heard of multiple macro hedge funds that have been buying Bitcoin as it relates to what central banks and governments are doing globally as a hedge. And so sophisticated crypto investors can see that bid through on-exchange analysis and on-chain analysis and conversations with OTC desks. And it was apparent throughout Q1 from the relatively muted price action in BTC. Remember, BTC wasn't leading this market. It was Tron, and it was Litecoin, and it was a bunch of small cap cryptos. But it's pretty apparent that bid was there, but that the bid was price sensitive over that period of time. But without that sort of safety net, risky whales couldn't have the confidence that the bottom wasn't going to fall out from underneath them. And because they did have that safety net, then they can start initiating this chicanery, which is my euphemism for another term. But that started in Litecoin and in small cap cryptos. So reflexivity. Raise your hand if you know what reflexivity means. You heard that term before? Reflexivity is it's really, really important in crypto. It's tremendously important in crypto. It was a term that was coined by George Soros. Reflexivity is this theory that a two-way feedback loop exists for investors' perceptions that then affect the market environment, that in turn change investors' perceptions. And reflexivity is more present in crypto than any other asset class, because crypto derives more of its value from network effect than any other asset class. That's a really important differentiation. And the more people that are aware of and own BTC or ETH or any other crypto, the more valuable it is. If the world decides that BTC is worthless and walks away from it, then the price can, in theory, collapse to zero. That's the strength and purity of network effect as it drives value for crypto assets. Because network effect drives such a significant portion of the value of the technology as a whole, higher prices beget higher prices and lower prices beget lower prices. And the collective market is constantly reevaluating the future potential adoption of crypto, and price action has a large impact on that calculus. And that's why things can get so wacky to the upside that we've seen multiple times, and it works just as bad to the downside as well too, where you can start spiraling into this sort of like a downward spiral reflexivity. The price is lower today than it was yesterday, so people are walking away from this thing, oh my God, I'm freaking out, sell everything, and then the other people, 2018, we all remember it. So reflexivity in crypto means prices tend to snowball, both to the upside and to the downside. And we've seen this play out multiple times in Bitcoin's 10-year history. Ending a bear market and the related negative reflexivity of prices can come from a marginal buyer that is willing to ignore the circular implications of lower prices begetting lower prices and provide an exogenous shock of sorts, a bucket of buying thrown on a fire of crashing prices. Oftentimes, such as in February, this exogenous shock of buying is accompanied with a string of positive fundamental news events. Jack Dorsey pumping BTC, Facebook coin, JP Morgan coin, Cambridge Associates reports, global resumption of quantitative easing, the combination of which is enough to get reflexivity moving back to the upside and quickly begins gaining reflexive momentum back up. I've had a career as an investor and done it in a bunch of different asset classes and up and down the capital structure and really liquid stuff and completely illiquid stuff. And I gotta say, watching reflexivity spiral, go from this like spiraling down to turning back up, which we've witnessed year to date, has been one of the most fascinating things I've ever seen a financial market do. It's like, it's really amazing to watch, actually. So then the marginal buyer and seller. So the price of any asset at any given moment is where a buyer and seller agree to exchange the asset. But that looks different in crypto, where most assets outside of BTC and ETH are highly illiquid. Market depth is so shallow that the relationship between the buyer, the seller, and last price is distorted relative to traditional, more liquid markets. And as such, when prices are reflexively spiraling down, all it takes is one seller to have a slightly more bearish view on the ever-changing value of network effect for prices to continue to make new lows. And the same is true to the upside. It's not the entire market that needs to decide prices should be higher. It's just one marginal buyer willing to have a slightly more bullish view on the ever-changing value of network effect, one marginal buyer with a slightly higher risk tolerance, or importantly, the illusion of a marginal buyer with a slightly higher risk tolerance or more bullish view to have prices move continually higher. Risky whales have provided that illusion year to date and may be providing it still. Finally, the damage of punishment. Markets get overbought and oversold all the time. Oscillators like RSI, stochastics, Bollinger Bands have been utilized for decades to understand when markets have gone too far in a bullish or bearish direction and a reversion to the mean is due. Over the last year, these reversions have often happened suddenly and swiftly via stop runs. 10% moves in an hour are witnessed on a regular basis. By many measures, crypto prices are overbought right now and a reversion is due. But the same could be said at 5,800 and 5,400 and 4,900. And during much of 2018, these reversions would show up all of a sudden with prices crashing violently lower. These crashes are damaging to investor psychology and in turn damaging to reflexivity and damaging to the marginal buyer. Risky whales, who were rewarded during much of 2018 by slamming the market lower with shorts and inducing capitulative high volume selling, allowing them to scoop Bitcoin up at rock bottom prices, are well aware of how precarious this rally in crypto is. After all, they manufactured it. These risky whales have likely made good returns shorting the market in 2018 and accumulating BTC at low prices. Anybody that's done like days burned analysis, if you guys are familiar with that, you can see how many days were burned in kind of mid-November to mid-December. A lot of Bitcoin changed a lot of hands at that period of time. But the profits available for this type of chicanery were dwindling. Volumes and volatility were drifting lower, and retail investors were leaving the space entirely. So a new violent slam lower at this point to go retest the lows or make new lows would be so damaging to the precariously positive reflexivity that risky whales have manufactured year to date that the negatives of such a move likely outweigh the positive of the profits that are made on the short side. So specifically, how did we get here? These three interrelated factors, reflexivity, the marginal buyer and seller, and the damage of punishment, as seen through the lens of risky whales, paint a picture of a precarious, manufactured rally. And many of our tools we use to evaluate this market jive with that picture. January, February, March timeframe, this was not a natural or a particularly healthy rally. Prior to April 1st, BTC volumes had been lackluster. Quality, by and large, did not lead us out of this bear market. But by understanding the drivers, the positioning, and the intent of risky whales, we can better understand the nature of this rally and its ability to continue. So in summary, where are we? BTC was up 30% in April. We're up over 63% year to date, up 90% off the bottom. LTC, BNB, EOS have performed even better. Broadly, how did we get here? The largest monetary and fiscal policy experiment in human history, globally coordinated quantitative easing while simultaneously running massive deficits on top of increasingly untenable debt levels. The Fed's dovish capitulation put the bottom into this crypto market. And specifically, how did we get here? The interrelated factors of reflexivity, the marginal buyer and seller, and the damage of punishment as seen through the lens of risky whales. And what are the chances that we've bottomed? In the 7 weeks leading up to the April 1st, the chances we would retest the lows of mid-December diminished significantly. The price action on April 1st and the weeks following essentially put the nail in the coffin for new lows. We would have to likely see a massive shift in appetite for risk assets globally. And to be honest with you, central bankers are going to make sure that's not going to happen. Thank you guys very much for your time. Appreciate it. You can find me on Twitter. We've got fun information, all that good stuff. Thank you.